Clyde Russell, Asia Commodities and Energy columnist for Thomson Reuters in Australia. And even though traders don't read your work and don't care about what you have to report, Clyde Russell, the good news is for you, they still buy your service. So they must be buying it for a reason. And your article this morning, Clyde, was very appropriately headlined, Iranian attacks on Israel give a muted response to the crude oil reaction. Your thoughts on what you covered in your article this morning and this sort of boom without a bang?
Well, I think, there's another old saying in the sort of journalism world of, you buy the rumor, sell the fact. So last week, I mean, oil did go up last week, and you could say that that was partly driven by fears of what Iran was going to do in retaliation. That question was answered over the weekend, and quite frankly, seems to be more of a symbolic retaliation than a real one. I can't think that the Iranians knew that most of their missiles and drones would be intercepted. They must have known that that was the likely outcome. They were hoping, obviously, a couple struck, but it was more that sort of symbolic thing. Look, we can hit back at Israel, we can hurt them a little bit, but we don't really want to do it too much. And you notice very quickly thereafter, you had Iranian talking heads on saying, that's it, we're done for now, everything's okay. So the message was very much, we've made a symbolic strike to save face, to show our supporters that we can do so, and now we're going to move on, and it's the ball's back in Israel's court. And you also then hear very much everybody telling the Israelis, just calm down, and let's see if we can de-escalate the situation. So I think the oil price is having a naturally muted reaction to that sort of thing. If you look at it, I agree with Omar. There's been a lot more bullish news over the last few months than is actually reflected in the oil price. And I can only really say that that's probably a reflection that demand isn't actually as good as OPEC or the IEA had thought it was going to be, that it's a little bit muted as well. But if you're actually looking at the weekend attacks on that, it really was actually, how can I put this tactfully, the best outcome for the oil market, because we got rid of the Iranian retaliation, and it doesn't look like we're going to get an escalation.
Clearly, it's early days. It's only the morning after the night before, so to speak. So there's still a lot of sort of swallowing what's exactly going on here. But clearly, there could be a momentum where the paper market's getting out, selling its profits, and maybe that's what we're seeing, this sort of slight dip in the morning.
Well, I think there's a definite element of that, the buy the rumor, sell the fact kind of thing. I think your question as to, are we in a worse situation now, or as
are we closer or further from a supply disruption, which is what we've been debating for months here? Okay. And this event, does it bring us closer to that happening, or does it bring us further away?
So if you go back to Friday, we're now further away. If you go back to December, we're closer. It all depends on where you actually start your point of looking at this. Is there an imminent supply disruption threat? I don't think so. I think you've got to look at the ultimate interests of everybody. Is it in Iran's ultimate interest to close the Strait of Hormuz? That would put them offside with everybody in the Middle East who uses that strait, and they would probably force a military confrontation with the US. I don't think that's in their interests. The Iranians are just getting back to a semblance of normality. Western sanctions are still sort of there in theory, but they're not really being enforced. Those can come back. You've almost got to look, who are the real beneficiaries from the escalation in the Middle East? It's not the existing countries, not even the Iranians. It's Vladimir Putin, because Russia's infrastructure is not under threat and he gets benefit of the higher prices. And you must say the other potential massive beneficiary of all this is Donald Trump. It makes his re-election more likely because it puts pressure on gasoline prices in the US, and it also allows him to run the line that, oh, the world is going to hell in a handbasket under Joe Biden, let's go back to me. But if you were the Iranians, do you really want a Trump presidency? No, because he's going to come after you, because that's what he wants to do. So, the Iranians have to play a very clever game here as well, and a very careful game, because if they end up with a Trump presidency, they'll end up with something they really don't want, because it will be a blank check for Israel. Trump will go all back in with his friends in Saudi Arabia, and they'll go after the Iranians. So in some ways, it's very much in the Iranians' interests to actually de-escalate. And I always say, you've really got to look at the difference between what people say and what they do. So, they might be talking a tough game, but at the moment, all the other signs that they really want to sort of end this as, well, I don't think it's going to end. I think Omar's absolutely right. I think the conflict carries on.
Well, it continues either in an elevated state or it continues in the
bubbling. I think what they want to do is keep it bubbling along, but they don't want to escalate it.
Clyde, meanwhile, also last week while we were away, China's first quarter oil import numbers came in, and they look very strong, reasonably. I mean, a little dip in March, but ultimately over the quarter, still knocking on the door of 12 million barrels a day of imports. Your thoughts on the first quarter and the outlook going forward for China?
Actually, they weren't really that strong. If you're actually looking first quarter to this year to first quarter last year.
Unless Reuters reporting is incorrect, I'm not sure. But
yeah, they're more or less exactly the same. In fact, it's just over 11 million barrels a day. If you do it on a barrels per day basis, they're actually slightly weaker this quarter because of the extra day in February this year compared to last year. So what you've really got is a fairly steady outcome.
Okay, steady is a good word.
You had a strong January-February period and a slight pullback in March. But the one thing that was interesting is there was quite there was quite a large drop in China's refined product exports in the first quarter. So that does mean that more of the crude they took and they kept domestically. They weren't exporting it as products. So that does speak to some strength in their demand. So there is a case to be made for that. I always say when the crude oil price rises, you've got to be wary of China's imports 4 or 5 months down the line, because they'll tend to pull back if they think prices have risen too much. Or they could be taking the view at the moment that they're going to rise even more, so we best stock up the next coming months. That's, there's a debate going on right now within the trading community in Singapore as to what the tactics should be. Do we buy as much as we can in the first half, because we expect prices to be much higher in the second? So that's kind of where they're thinking. So I think the bottom line is China's import demand is probably going to hold up fairly well over the coming quarter. That's kind of where I see
OPEC will be watching that quite closely. They're meeting in 6 weeks' time in Vienna. Big meeting expected to whether they can open the doors to start loosening their cuts. Will China deliver them an opportunity to do that, do you think?
Well, I think there's a lot of behind-the-scenes talking that goes on, and I think the Chinese will be saying, if crude oil price remains, sort of not really much above 90, we'll happily we'll buy a bit more, and if the crude oil price goes above 100, we'll stop buying, anything extra, and we'll use up some inventories. I think I don't know if they actually directly tell producing countries that, but I think they basically, in their monthly
they do through their monthly imports, I suppose. I mean, that's what the data says.
The message is delivered. It's, obviously the world is much more than China demand, but you got to think that you put oil back above $100 a barrel, it's going to start crunching demand. And not just in the Western countries, you're going to see a lot of developing nations across Asia, Africa. That sort of price level starts to really hurt, and people basically stop driving, and industrial activity falls, construction stops, diesel demand goes down. So it does have an impact, and I think OPEC will be aware that you go above 100 in the current environment, it's going to have a bigger effect on demand.